Welcome back. You're still watching at Tomorrow's Trades right here on ET. Now, Richard Hunter, head of equities at Hargreaves Lansdowne, joins us on the show. Richard, what is the market expecting ahead of the ECB meet?
At the moment, the signs are reasonably positive. I mean, there clearly is only one show in town today. That's probably been the case for the last few working days. But there seems to be, just ahead of the interest rate announcement at 12:45 British time, followed by the comments at 1:30 British time, there seems to be increasing optimism that there is actually going to be some kind of unlimited bond buying announced by the Fed, by the ECB, which of course would signal something of a resolution to the Eurozone crisis, because I think it's fair to say that until such building blocks are in place, it's only then that thoughts can turn to the equally important question of stimulating economic growth within the region, and clearly that's had to be put to one side up until now while the debt situation is being looked at.
What is the expectation of how things may really change in terms of risk appetite after this meet?
Well, that's very much going to depend on what we hear. Clearly, as I say, the expectations are growing. The FTSE 100 is in positive territory at the moment, as was the Dow just about yesterday. Any lack of concrete action, as we have seen so many times in the past, would more than likely equate to disappointment by investors, and you could see the market take a downward leg on that basis. Obviously, we've got the other elephant in the room of a slowing Chinese economy at the moment, which is certainly not helping the outlook for the global economy. But it's kind of one thing at a time, and clearly in terms of today, it's the ECB announcement which is the primary focus.
All right, Richard, many thanks for joining us and giving us that quick perspective. Let's also get in another view from Ben Kwong, who is the CEO of KGI Securities, who joins us on the show from Hong Kong. Ben, thanks very much for speaking with us. The market seemed to have priced in a bond buyback announcement by the ECB, which should help peripheral economies. But what if the ECB does not deliver? What should one expect?
Now the investor expecting that the ECB will announce his bond buying proposal, which focuses mainly on the government bonds and with shorter date maturities up to 3 years. So if that is more or less in line with the market expectation, maybe the market will make use this as an excuse for short-term profit taking. It is because of the bond buying plan will need to seek the support of those major European countries, and also have a lot of the details to be ironed out. So there also causes some sort of uncertainty to the market.
Assuming that the ECB does deliver to the expectations of the market, how long do you believe the exuberance would last? And how soon before the market start focusing again on the fundamentals of the region?
Yes, quite right, because of the even though now the ECB strike out a bond buying plan, but it doesn't mean that this will help to improve the current situation of the European economy. And if you look at the recent PMI, I think it's still in pretty bad shape. Investors will continue to worry about those financial and economic situation of those countries like Spain and Italy. So that's why we may see some profit-taking pressure on euro-dollar as well.
One view in the market is that the ECB may initiate another round of rate cuts, but what do you think another round of rate cuts really do for the economy that is really seeing negative growth right now?
Oh, yes, the market also expects that the ECB will also announce some sort of stimulative measures, such as the rate cut, to help those weak European countries. But even though there's a rate cut, I don't think that will have too much impact on the market.
There is too much that people are coming to expect from the ECB. Obviously, I mean, monetary policy action cannot replace the structural reforms that are so urgently needed in most EU economies. Do you think governments are moving fast enough on the fiscal reforms front?
That's quite right. Now the ECB is just focused on the monetary side, but there's still a lot to do on the fiscal side. So maybe in the coming months that the more effort will be focused on those fiscal restraint on those major European countries, particularly for those heavy debt countries.
The euro has been quite resilient in the face of this crisis. Where do you think the single currency is headed?
I expect that euro may retreat back to around 1.24, and that seems to have an initial support, but further upside will be relatively limited. It all depends on whether there will be another round of quantitative easing in the U.S. If the Fed adopt another round of easing, maybe that will put further pressure on the U.S. dollar, and then that will indirectly help to sustain the strength of the euro dollar.
Okay, leave it at that. Thanks so much for joining in today and giving us that perspective. Let's take a break on that note. Of course, here out Prakriti Sofat, economist at Barclays, and Gerard Lyons, chief economist at Standard Chartered, who expects the ECB to ease rates in today's meeting.
From the ECB, we're actually expecting a 25 basis point cut on the repo rate, but no change on the discount rate. I think in addition, the central bank would announce some sort of measures to ease lending conditions for small and medium-sized enterprises across the Eurozone. Importantly, however, we believe that the ECB and President Draghi is going to give some clarity and information about the bond purchase program from the central bank.
Well, I think the ECB has quite clearly indicated it has a bias to ease. I think this week the ECB will actually cut rates. The market's not expecting that. Well, the message I took from Bernanke's speech was the Fed still has a bias towards easing, but it's not going to ease immediately if it doesn't have to. So it would be very dependent upon the data. That means that quantitative easing, or QE3, is still likely at some stage. Our view is that it's likely to take place next year, not this calendar year.